I decided to focus on capital markets. Even when you go into capital markets, you still have to decide what asset class, what type of
Right.
capacity your loans are.
Yeah.
And that you're going to do that, I feel like inherently with the business because real estate is such a wide scope, Jason, which you know this just as well as me. And it's one of those things where you really do have to narrow down because if you don't, you could just be, a jack of all trades, but a master of none.
Hey there, I am Dr. Jason Ballara, and this is the Know Your Why podcast, where we explore the why behind success. Every week, I meet with real estate investors, veterinary entrepreneurs, mindset coaches, authors, and fitness professionals to uncover their why and how it drives them on the winding road to success. What is your why?
Hi, everyone. I'm Jason Ballara, and this is the Know Your Why podcast. Today, I'm here with Culby Culbertson. Culby's a Dallas native, focused primarily on real estate investment with diverse experience in the capital markets, investment, and as an advisor. To date, closed an estimated of $350 million in commercial transactions. Maybe that's even gone up since that was written. But Colby, I'm going to stop there so I can let you tell your story in your words. But I first just want to say thanks for coming on the show. Thanks for taking the time out to be here today.
Yeah, absolutely, Jason. I appreciate you having me on. Always enjoy connecting with guys like yourself and chatting with like-minded folks. So yeah, quick background about me. I'm here in Dallas. Born and raised in Texas. Spent some time out in West Texas for a while, and back when oil was cool. Spent some time in the oil industry and came back to Dallas, got in somewhat of the financial services, real estate space. Been doing this since late 2018, really started moving in 2019, primarily focusing on organizing capital for residential, industrial, retail, office, hotels. I would say a predominant focus is going to be on the multifamily, single family side, and the subsets within that. So mobile homes, student housing, build to rent communities. We could talk about the subclasses of residential all day long. Good blend of construction, existing value add. So if there's a purchase plus some type of construction component, someone coming in, creating additional value, whatever that may be, we can find a really competitive home for it. And that's kind of what we're known for and what we've been doing many times over, really across the nation.
Yeah, yeah, that's fantastic. And I mean, I don't know exactly how old you are, but you seem like a young guy, and been started in real estate or been in real estate here for a few years, and probably seen some seen some interesting things in the market. Certainly,
Yes,
as we
sir.
all have over the last few years. When you when you got started, I mean, you said you were in oil. I used to live in Houston, so I know it's a big deal in Texas. But when you decided to make that shift into real estate, kind of what was the what was the motivation behind that, and what first steps did you take?
Yeah. So, a lot of good friends of mine, when I came back to Dallas, were involved in, either financial services or real estate or something along the lines. And, at the time, a friend of mine was in construction, was able to kind of lock arms with him and, start kind of doing what a lot of guys do when they get into real estate. They try their hand in wholesaling or flipping homes, and I'm doing
Yeah.
demos and swinging hammers and doing all the things. And I'm usually a pretty quick read, Jason. And I saw the light pretty quick as to what, where the real players play the game and what was a deal, right? And so I was able to kind of meet the right folks at the right time. Everybody likes to call it luck. Some people like to say it's preparation. But I just really try to get myself in as many conversations, get in front of as many people as possible. That's really what you got to do. I mean, there really is no other secret sauce other than, if you come from a family that's already doing it for years and years, but that comes with its own challenges as well. So I think if someone's wanting to get into real estate, the best thing to do is really just to get out there get in front of people, make the calls, and do your homework. I think is really the best way to accelerate in this world.
Yeah, it's very much a network driven kind of industry, in the sense that it the more people you know, because entrepreneurship and real estate is very much about sort of problem solving, and what's I've noticed is really cool, but as my own network has expanded, is that then you have more and more people that may have either experienced that similar problem or might be able to help you when you run into something like that. And so you can leverage all those resources, just like the human experiences that the people around you that you've added to your network have, and use that to kind of move yourself forward and provide value to them in return. I think it's kind of a it's been one of my favorite things about it, over these last 3-4 years of connecting with people. The podcast has helped a lot, getting to talk to people and just kind of find out what they're doing, what works for them, what doesn't work for them, and then kind of using those as stepping stones to grow.
Sure.
And you mentioned that you tried a lot of different things kind of in the beginning, and I think I'd love to get your take on this, but one of the things I think is maybe one of the best things about real estate investing, but also sometimes one of the worst things, is that there are so many different ways that you can be active, or I shouldn't even say active, because you can also be passive, but be involved in real estate, that sometimes it gets easy to get kind of shiny object syndrome, if you will, and just kind of bounce around. Did you feel like that was a little bit of a something that you experienced in the beginning?
You know, there is, I think there's a blend of that, even if you were to find a home, right? Because, for example, when I decided to focus on capital markets, even when you go into capital markets, you still have to decide what asset class, what type of
Right.
capacity your loans are.
Yeah.
And, that you're going to do that, I feel like inherently with the business, because real estate is such a wide scope, Jason, which you know this just as well as me. And it's one of those things where you really do have to narrow down, because if you don't, you could just be a jack of all trades, but a master of none. And I think in this business, you really have to focus in on either a specific asset class, or at least within a certain box, because next thing you know, you're chasing event centers and assisted living facilities and also retail centers and also multifamily. And if you know the business, the same capital sources are not going to be consistent there. The investors are not going to be consistent there. So you're having separate conversations, chasing separate brokers, separate investors, separate lenders, and all of that just doesn't really correlate. Whereas if you were to say, okay, I'm going to do residential, I'm comfortable with multifamily and mobile homes, student housing, build to rent communities, I could find a way to kind of correlate that, better understand the types of capital sources that are available out there, and correlate that in a way to where it makes it very efficient. So for me, can I finance all different asset classes? Absolutely, at any capacity, frankly. But I would definitely be more comfortable if I took on 10 deals today. I could go to 10 lenders and I could absolutely get them financed, no question. But if you bring me two hotels, two event centers, two multifamily deals,
Yep.
and whatever additional number that is equaling 10, then I would probably have to go to many different subsets of lenders, which ultimately is going to kind of skew my thought process. I may have to switch up my presentations. The conversations will be different. So I would definitely encourage people to find a niche and just really lock into that, because they'll find more meaningful conversations. They'll learn more at a faster pace. And realistically, if you can get gross lease down from an underwriting perspective, you could peel back the onion, because if you can understand gross lease underwriting, triple net is going to be a breeze.
Right.
So I think there's a lot of merit to that.
Yeah. I think you just sort of reiterated the point, because there's so much, right? There's so many you listed off several different asset classes. You listed off several different roles within the, sort of real estate, whether it's a syndication or whatever. Like there are, brokers, lenders, attorneys, CPAs,
Yep.
operators, construction managers. I mean, there's a million different places to be, a million different seats to sit in within a million different asset classes, or even these asset classes might have different strategies around them, right? You might,
Sure.
people talk a lot about, short-term rental. Well, then, you add in medium-term rental and things like that. So it's really important when people are starting to probably pick their niche and focus on it. It doesn't mean you can't ever do anything outside of that, but if you go into it trying to be kind of involved in every single different little piece, it's gonna make it hard for you to really kind of find get a foothold in any one particular area.
Yep.
As you've grown your business over these last few years, what challenges have you encountered? What are you specifically focused on, kind of as we're moving through a bit of a tumultuous market?
Yeah. I mean, easy answer here, Jason. Rates have been pretty tough.
Yeah.
Coming from a point in time where rates were historically better than they've ever been
Hmm.
to, in my lifetime, worse than I've ever seen in my working career, and there's a lot of guys out there that are much more experienced than I. But luckily for myself, I'm not so naive to ever think that I know everything. So I'm very good at absorbing information from guys like that. And I think that there, even with the utopia that we lived in with sub four rates, realistically, more volume was done in just the years prior and just after that, because even though rates have been a huge challenge, rates at 3%, 3.5%, it's not good for anybody. And you know why? You're buying properties way outside of what you should have been. You're buying properties at a higher purchase price because it underwrites with a much better rate. And so now, when your maturities are coming up, 5-year deals or 2, 3, 4 bridge loans, whatever that is, which everybody's seeing this, it's all over LinkedIn and Bloomberg and all that good stuff. Nobody's safe. Now you're in a spot to where you're upside down and you have to sell this property either at a loss or at a point to where nobody's excited about it. So I'd say, getting people to better understand the actual history behind where rates have been. And if you look kind of on a map, kind of like a Richter scale of going back to say 2010, where we're at today, realistically, Jason, we're not that far outside of what the marker is. Back in 2018, late 2018, early 2019, if I were to bring you an agency loan that's, between 4.75 to 5.25, we're playing ball all day long.
Yeah.
But then it got to people were like, oh, well, I got a lower rate, 3.25. I got 2.99%. It's like, okay, fine, but how are you going to sell it? So I think now it's been healthy for the market. So the biggest challenges that I've really seen is educating some investors on what their expectation really should be, and then also being able to do the math behind what type of exit to be able to anticipate, while also really working with different profiles of investors, because a lot of the sophisticated investors are starting to come back in the market, but there was a point in time when a lot of the investment sales brokers, for example, that I work with consistently, may have been considering less qualified buyers because of the buying pool being a little bit more um, inactive than it usually is. So I
Right.
think that there's different subsurface level challenges out there with market changes like that.
Yeah. And the way you kind of ended that, I think the rates, as you pointed out, are the rates that we have currently now are not really historically abnormal, right?
Right.
What we had 2 years ago was historically abnormal. That was
Right.
like lower than, as you said, lower than we. What also happened is the rates rose faster than they ever had,
Right.
and to that extent than they ever have
Well,
in a
think
short
about
period
this,
of time.
Jason, with a comparison of oil, right? This is back in 2016 when I left Midland to come back, which, I did 4.5 years in Lubbock and then 2 years in Midland. I wasn't too upset about coming back to Dallas at that point.
Right, right.
But, when I started in the oil industry, we were about 105 a barrel to 110, 115. In 2016, that declined at a rapid pace. I think at one point oil went negative, which
Mhm.
that's never happened before, at least not to my knowledge. And so what goes up must come down. It's literally Isaac Newton's law. And I think it's the same thing. What goes down must come up. So it's one of those things where it's a slow fall, but it'll shoot right back up, or vice versa. So we're seeing it firsthand right now.
Yeah, yeah. I think the rates certainly matter, and what happened with the rates has caused a lot of pain. But I think what really matters is the debt structure. Like the specific lender and the debt structure
Mhm.
matter. The actual rate matters, right? Because how things are going to be calculated and impacted by the rates being higher. But again, it's, as you said, there was a lot of bridge lending going on, 2-3 years ago, because that's the only way it worked, right? Which in hindsight, maybe that's a red flag, but also at the same time, if you want to transact and be able to be in the market, you almost had no choice in terms
Sure.
of doing it. So it's weird the way it happened, and it's like it's a lot like it's a different set of problems than 2008, but it's similar in the sense that in hindsight people can say we should have seen this coming, but in reality, like, everybody's kind of doing what the market, they're trying to be competitive in the market
Yeah.
as it currently exists, and
Right.
so you have to think about that. And I think, and each of these big market swings, like 2008, like, mid 2022, when things started to shift, they have to be learning lessons, and people will, do things different. I think that the worst thing that comes out of these types of things is that, in my opinion, is further it further widens the wealth gap, in the sense that, like, wealthy people are going to look at, where we're at now and be like, okay, now's the opportunity. We just saw Blackstone just, come in with a $10 billion purchase of a REIT. Like, the institutional players are starting to come back into the market, but the you know beginner retail investors, a lot of those people are afraid because, oh, I invested in a deal in 2021 that's not doing what it was supposed to do. And so, rather than recognizing an investment portfolio as a like long-term continual process, it's
Right.
like, oh, I'm scared, I'm not going to do it again. And I
Right.
think that's the worst thing that comes out of these types of situations in a lot of cases, is just like people uh they get
Sure.
burned and they don't do it. They stop investing, and so they're
Well,
not.
they jumped into the party is what really happened.
Right, right.
And think about how easy it is for, some of the syndicators out there. We got a 3.5% rate, interest only. It's going to be a great deal. They're leaning on this good rate, this
Yeah,
deal that they got because it was a seller's market. Sellers were selling like crazy. You know what I mean? Of course, a lot of people jumped in, but a lot of people jumped in because they were getting, maybe 80% leverage with a SOFR plus 375, which
yeah,
375 at the time was actually 375,
right.
because SOFR wasn't even 1% at one point. It was like sub 1%.
Yeah,
So, of course, there's so many people that wanted to play the game because these syndicators made it seem like it was so easy. But, you also don't see a lot of those guys out there anymore, and that's a conversation that we probably don't have time for. But, I think that there's a lot of folks out there that did get, somewhat of the short end of the stick because they got in bed with a group that was very good at marketing and really their technical analysis and their property management and their actual asset management and follow through really probably wasn't as um, sophisticated and shiny as their webinars and stuff like that. So the unfortunate truth is it's really hard to raise money right now
Mhm.
because of the bad taste that's been left as a sentiment
Oh yeah.
from those years. I,
Yeah.
I personally know this. We just raised some capital on a 27 unit development deal and working on in Bonham near Sherman. And, I've raised capital before. I've closed on a couple different multifamilies. I've done some deals of my own, and I'm literally inundated in this business. And you would think that a guy like myself could go out there and grab it, but it's just the technical analysis in this world is just much more constrained. People need more answers. Banks need answers. Investors need answers, and it's really just not as easy as people think. And but here's the facts. The market's becoming healthier. I
Mhm.
think that it sure has slowed down. That's fine, but the slow and the volatility and the activity in the market is good for investors because now people are slowing down. They're actually doing their underwriting. They're doing their homework. They're taking the time to understand who the operator is, who the lender is, what their exit looks like. What type of asset management are they actually doing? Is there on-site property management? Are they firing the manager once they take over and the lender's not looking? There's a lot of factors that I think that were overlooked in 2020, 2021, even bleeding into 2022, that now we have, you know, healed from an investor standpoint, and you'll start seeing more activity as this becomes the normalcy. I don't think that rates are going to get that much better. I really don't. I think that rates will probably come down one or two more times, maybe three, if you're lucky. But rates have gone up 30 basis points, Jason, since April 1st. 30 basis points. They said that they were going to lower rates. They just didn't advertise it on Bloomberg. So I think that this is here to stay for a while. And I think that people need to start, really becoming understanding of how to really understand these transactions if they want to participate and or really get to know the investor that's asking them for money. You know what I mean?
Yeah. No, yeah. I excuse me, I agree with that. I think it's a complicated time, and people that don't specifically work in the market are being confused, scared, burned, whatever whatever they may have experienced over these last couple of years. I think is um, it's definitely impacting the ability to raise capital. And I like what you said about things have slowed down, and that's really probably for the better. It was uh, uh, things will level off again, but it seems like unfortunately most markets, whether it's real estate, stocks, whatever it is, even the Fed, just it's all reactive. Nobody's actually doing anything proactively to try to avoid things. It's more
Yeah.
like, what happened? Now we get like, let's
Right.
print all this money. Crap, there's a lot of inflation. Well, now we have to shoot rates up very high. It's like,
Yeah.
well, of course that happened, really. Like, it's kind of like, in hindsight, and I'm not an economist. I don't know that I would, in hindsight now I can say, sure, of course that happened because I understand. But you would think that the people pulling those triggers would understand what
Yeah.
this means. And
I don't know what we can lean on this administration for, but, I definitely think that when it gets closer to election, I think that we're going to start seeing some level of relief at the market. I think there's a lot of things that are going to be happening over the next course of the next few months that we haven't even seen the start of yet, unfortunately. And a lot of people are waiting to see what that is, whether
oh,
that's
yeah, I'm
rates
sure.
coming down or war, unfortunately to say, or, you know, something, just something. It's election year.
Right.
There's always something. So I
There's
think that we're coming into a place where I think realistically investors should start being a little more comfortable, being more relaxed, because the market has leveled out. I think that sellers are coming to their senses, cap rates are widening, lenders are coming back for the right deals. Agencies are still pricing sometimes under 6%. There's
Yep.
life goes out there that are pricing mid fives. They're not getting super aggressive on leverage, but they never really have. I just think it really comes down to buying right, as opposed to locking in a super low rate and putting a little bit of money in. If you can get in a deal at 65%, 70%, you're going to be in a good place no matter what happens in the market, obviously within reason. And I'm seeing a lot of guys be more comfortable with that. Because if you raise money on a deal that's at 65%, odds are you're cash flowing in a way to they're going to start getting some of that money back. Whereas if you're levering up with a higher rate, you're going to compress your underwriting. You're not going to see cash flow at a faster pace. You're really heavily relying on the exit. And there's so much unknown still on where cap rates will be, on rates will be, just a lot of factors. You're getting me down a rabbit hole at this point, Jason, but the supply constraint or the supply surplus that's in Texas on apartments, the rent growth is slow. There's still cranes all over the sky, mostly apartment buildings. That people see an old gas station, try to convert it to a multifamily these days. It's like I think that there's just a lot of factors that have slowed everybody down, but I think it's for the better because now people can really learn how to actually underwrite these deals, take consideration for the variables that count, and over time, which I think in the very near future, once these rates kind of settle, which I would imagine at the end of this year or early next, we're going to start seeing a lot more activity. The saying "survive to 25." We're almost there. We're almost into Q3 here. I guess we just started Q2, but we're almost halfway through the year. Put it that way.
We'll be there before we know it. That's for sure.
Exactly.
It seems at times that it's dragging, but also you think about. It's interesting to think about. COVID started 4 years ago. Like
Right.
you start to lose track of time and in in different stages of life. But Colby, let me switch gears. I want to get to ask you the questions I ask every guest. The first one, of course, is being related to the name of the show is Know Your Why. What is your why? What's driving you? Kind of what keeps you going on the hard days?
Well, one, I'm standing in my house right now. I've got a family. I got a fiance, Kelly. We've been together for about 5 years, and we're getting married next year. We've got a 4-year-old together. We kind of did it backwards, had a baby and then bought the house, and now we're getting married. So I definitely have a lot of drive in the morning to get up and make sure that they're happy, and not only that, I myself, I want to do everything I possibly can to reach my full potential. I'm one of those guys where I want to see the top of that mountain, and I don't care really what I got to do. I'll get up at 5 in the morning. I'll stay up till 5 at night. And, I've been hard pressed to really find a lot of folks that are willing to put in the same kind of work I am. And it's really shown, I've a lot of fruits of my labor in the life, and I'm certainly not done yet. So I think a combination of self-fulfillment along with keeping my family first is the biggest whys for me.
Love it. I love it. Tell us something about yourself that isn't common knowledge, special skill, a hobby, anything you're comfortable sharing just to let the listeners know you a little better.
Yeah. I mean, I would say, from a sports perspective, I've always been real big on sports. I'm still very active and, getting in the gym, obviously. I still play basketball quite a bit. Now that Hudson's a little bit older, I can't wait for him to be in sports. It's going to be great. But, I've been in sports all my life, still keep up with it quite a bit. And, I guess that would be it. I mean, I'm so inundated in real estate, Jason. Sometimes like it's just,
Yeah.
I eat,
No
sleep
time
and
for
breathe.
hobbies.
Yeah, that's right. So I eat, sleep, and breathe buildings and interest rates. So outside
Yeah,
of that,
yeah,
I try to, stay fit and
yeah,
keep my family happy.
yeah, yeah. No, I get it. When people hear this and they want to reach out to you, what's the best way?
Absolutely. So I made my email, my name on the bottom there. So culbertsonholdings.com. That's my email. My LinkedIn, I'm fairly active on LinkedIn. Social media like Facebook and stuff like that. I would say LinkedIn's the best. Email's right there. And when you email me, I'll respond back, which you'll have my cell phone and my signature. Always willing to meet people, whether they're new, veterans, whatever it may be. There's always a place, there's always a deal, somehow, some way. Happy to interact with anybody. If you got questions on what I'm seeing, what they should be doing, how they can get involved, always open and ready for new relationships.
Awesome, love it. Well, Colby, excuse me, sorry. Thank you so much for coming on the show today. I appreciate the time that you spent with us and kind of
Yeah,
sharing your story. It was awesome getting to talk to you.
wonderful. All right, Jason, thank you so much.
Yeah, absolutely. Folks listening, I know you're going to love this episode. Please like, rate, and review the show so we can get more great guests like Colby. And thank you all for listening.
Hey there, I am Dr. Jason Ballara, and this is the Know Your Why podcast, where we explore the why behind success. Every week, I meet with real estate investors, veterinary entrepreneurs, mindset coaches, authors, and fitness professionals to uncover their why and how it drives them on the winding road to success. What is your why?